Hey guys, welcome back to another video. My name is Josh, and in today's video I'll be showing you how you can build a $10,000 portfolio, or essentially how you can invest $10,000. So building a portfolio is like baking a cake. To bake a cake, you need the ingredients. You also need the recipe to make your desired cake to suit your appetite. And lastly, you also need to go to the shop to get the ingredients. So in this example, the ingredients are the different types of asset classes that you can chuck into your portfolio. So for example, there's stocks, there's bonds, real estate, commodities, crypto, cash, and the instructions to make the cake is essentially the asset allocation of your portfolio. So how much of your portfolio you want to allocate into stocks versus bonds versus gold, for example. And the shop is essentially the different platforms that you can use to buy the different types of assets. So I'll be talking about all of this in today's video. As well as that, I'll be sharing with you my portfolio, so my public portfolio that I talk about on this channel, as well as the private portfolio that I don't really talk about on this channel. I'll be showing you my portfolio allocations for those two portfolios in the video as well. And as always, this is not financial advice, purely for entertainment purposes only. You can read the full disclaimer down in the video description below. But without further ado, let's get right into the video. So with your $10,000, you need to sort these things out first, okay? If you don't have an emergency fund, essentially 6 months worth of expenses, be sure you sort that out before you start investing that $10,000. Also, if you have any large expenses in the short to medium term that you know are going to come up. So for example, if you're going to buy a car, if you know you have medical expenses to pay, as well as, potentially a house deposit that you're saving up for, then don't invest that money. Leave that aside. And lastly, whether you have any high interest-bearing debt. So for example, if you have a personal loan or a credit card debt that charges you high interest rates, so anything above 6%, I would say, is pretty high interest rates. So pay that off first with your $10,000. And once you do all of that, once you've sorted all those things out, then that $10,000 that you have left can go into investing. So this is always a good checklist for any amount of money that you have. Say you don't have $10,000, if you do have $1,000, same thing applies. That $10,000 is just an arbitrary number that I've used. But same could apply if you have $1,000, $5,000, or $10,000, and any amount really, okay? So do all these things first before you start investing. The next thing that you need to do then is decide what type of investor are you. So there's generally two types of camps when it comes to different types of investor. So on one end, you have the passive investor. So the passive investor invests generally in ETFs or exchange traded funds. An exchange traded fund essentially tracks a market index. So for example, an ETF tracking the S&P 500 will buy up the stocks that are within the S&P 500 index, which essentially are 500 large companies in the US. Likewise, you could buy an NZX 50 index, which tracks the largest 50 New Zealand listed companies. So that passive investor will just buy the ETF, will set an automatic payment and do nothing, all right? They'll just leave it as that and automatically it'll get invested. The passive investor won't do any research. They'll just set up an automatic payment and that is investing done for them. On the other hand, you have the active investor. So the active investor will do a lot of research on stocks and the person will find the best stock that they can find and invest their money in that stock. And the active investor might, buy and sell regularly or even be a long-term investor. But essentially the active investor will pick their stocks and the goal is to make a lot of money, right? So an active investor will try to generally beat the markets. The ETF investor will say, I don't have time to research stocks. Numbers are boring and or difficult for me to understand. I like a set and forget approach. I'm satisfied with a 6 to 8% return on my investment over the long term, and I want to invest with the least amount of risk of losing my money. On the other hand, you have the individual stock picker who would say, I have a few hours each week to research stocks. I like taking the time to understand businesses and numbers. Monitoring stocks frequently is an enjoyable activity, so that means going on the Yahoo Finance app, refreshing every hour. I want to outperform the general market and retire before 40. I don't mind taking on more risk as long as my returns compensate the added risk. Right? So that is the individual stock picker versus the ETF investor. There might be some people on one extreme end or the other, but chances are you'll probably be in between here or there. So for example, you might not have a lot of time to research stocks, but I'd say most people want to outperform the general market and retire before 40. There are a few things that you need to weigh up. If your current goals are to earn a 20% return over the long term, over the next 10 years, and you don't want to do individual stock picking, then chances are you might need to reevaluate your goals now. You might have to change your goals to, instead of achieving 20% return, actually now you should only have 6 to 8% returns over the long term. Now that you've figured out what type of investor you are, next we have to figure out the recipe, which is the asset allocation. According to Wikipedia, asset allocation is an implementation of an investment strategy that attempts to balance risk versus reward by adjusting the percentage of each asset in an investment portfolio according to an investor's risk tolerance, goals, and investment time frame. Now, just before we did talk about goals and risk tolerance as well, generally an ETF investor wouldn't want to take a lot of risk, whereas an active investor, active stock picker, would tend to take on more risk. So because everyone is obviously different, I can't say what is the best asset allocation. But I will show you what my asset allocation is for my portfolios later on in this video. So this is the asset allocation, the recipe that will make your cake. If you want a really high risk cake and you want to make that real quick, then you need to have high risk ingredients, right? If you want a safe cake that will eventually make itself after a while, then you need safer ingredients. So next, let's talk about the ingredients. Understanding risk. Generally, the shorter your investment horizon, the higher the weighting of your portfolio towards the low risk scale. So in this picture, it's on the left because I have low on the left and high risk is on the right. Now, there are different types of asset classes that are on this risk scale. So cash, bonds, and gold tend to be on the lower risk side of things, but with lower risk comes lower expected returns. You don't expect cash to make double-digit returns annually. They generally don't make any real returns. Moving up the risk scale, we have real estate, which tend to be pretty safe investments. And going up the scale, we have stocks, which tend to be on the higher side. And I would say crypto, which is quite speculative in nature, is on the highest end of the risk scale. Now, I do want to caution you that not all assets within an asset class will rank the same in the risk scale. So for example, within stocks, we have different types of stocks, right? So we have dividend stocks, value stocks, and growth stocks. So for example, dividend stocks would be less risky in general compared to value and growth stocks. The reason why I say that is because dividend stocks tend to have consistent cash flow that they can already pay out to the owners, shareholders like you and me. Whereas on the other hand, we have growth stocks which tend to be unprofitable. There is a lot of risk involved because we don't know whether they would end up being profitable, and there's also a chance of them going bankrupt. So a growth stock would tend to have higher risk, but at the same time also higher expected returns. If you have a high investment goal of having 20+% return per year, then chances are you need to weight your portfolio towards the growth side of things. But if you want a relatively safe portfolio, then you should weight your portfolio towards the middle of that risk scale. So that's just something for you to think about when you're making a portfolio. So now I have a chart here from ASB KiwiSaver, which helps us give us a framework roughly on how to structure your portfolio. If you like a risky cake or a growth fund, this fund, you should have a minimum investment time frame of 11 years. And this fund makes up 20% of income assets being cash as well as bonds, and 80% growth assets, which are stocks and real estate. The summary of this investment objective is to aim for high total returns. Okay, the number of years with negative returns are generally expected to be the highest of the fund. So while you also have higher returns, there's also more volatility. So there will be some years where you will lose money. And that's why we do need to have a higher investment time frame, because in the short term, there's a chance that you'll lose money, but over the long term, you will make more money than, for example, a New Zealand cash fund, which invests 100% in income assets but at the same time, there won't be a lot of capital appreciation over the long term. This is a scale of risk, more risk being on this side and less risk being on this side. So you can see how the income assets increase as a proportion of your total portfolio as the level of risk that you take goes down, and if your investment horizon also goes down. So the longer that you have in the market, the more risk that you can afford in general. It does really depend on your individual circumstances. So now that we have some ideas of how we can structure a portfolio, but you still haven't decided yet, here is a strategy for you. It is called the core satellite strategy. Now, Investopedia defines core satellite as the core of the portfolio consists of passive investments that track major market indices such as the S&P 500. Additional positions known as satellites are added to the portfolio in the form of actively managed investments. So essentially you have a portion of your portfolio in ETFs that are passive. So you don't do much with that. It's an automatic payment and you dollar cost average into that particular product. So for example, S&P 500, NZX 50, you can mix and match as much as you want. It really does depend on the individual. And then after that, you might have some high conviction plays. So for example, if you think a stock is going to do really well, then you might buy a position in that particular stock as a satellite position to your core holding. So if you're an ETF investor, but you also want the fun of picking individual stocks, then a core satellite strategy might be useful for you. And this is also a good way to mitigate some risk. So for example, if your stock pick turns out to be a real dud and you lose all your money, then at least you still have your core holding that would generate you market returns. So while you might underperform the market, you won't go completely wrong the other way as compared to people who pick 100% of their individual stocks. So there is merit to this core satellite strategy. And this strategy is something that I've actually used in my public portfolio on Sharesies. So on this channel, I do run a Sharesies public portfolio. I do document the results of my portfolio, the movements within the portfolio on this channel. You can check out the most recent portfolio update in the link above. But here is the asset allocation on my public portfolio. Essentially, I have 42% of the portfolio in shares. ETFs make up 35% of the portfolio. Blend, which essentially I categorize blend as shares that have an exposure to real estate. Some shares invest a lot in real estate, so when real estate prices go up, the share prices also go up. So there's a little bit of an exposure to real estate as well as shares in the stock market as well. And that's why I categorize that as a separate asset class. But depends on how you want to define it. This could go into shares as well. And lastly, I do have 7% in real estate investment trusts or REIT. I don't have any cash in here because cash is in my private portfolio. So I've deviated a little bit from this core satellite strategy, but when I started this portfolio, ETFs did make up 50% of the ETF and 50% in other shares and blends of real estate and stocks, right? So this is now currently the asset allocation on my public portfolio. In my private portfolio, however, I do have 64% in shares, 19% in blend, and 4% in cryptocurrencies. So I did mention on this channel that my targeted asset allocation for Bitcoin especially is 4 to 5%. Currently it is at 4% of my portfolio. So, it's a level that I wanted to be in to gain enough exposure to Bitcoin, but at the same time not risking everything on Bitcoin, because Bitcoin at the end of the day is still a speculative asset class. But over the long term, I expect them to do well. Historically speaking, the research does show that it actually does provide higher risk-adjusted returns into your portfolio. So that's why I have cryptocurrencies as 4% of my portfolio. I have 3% of my portfolio over here, a small slice in art. Essentially, art is my Pokemon card collection. I did collect a lot of Pokemon cards back in 2016. I still have a lot of those cards in 2021. The value of those cards have gone up over time. So it might have been 2% last year. Now it's at 3% this year, but it's a level that I'm comfortable with. And even if those cards lose their value, it's only 3% of my asset allocations. And lastly, I do have 10% of my portfolio in cash. Now, this cash position is slightly lower than what I'd like it to be because that cash position does actually include my emergency fund. My investable cash position is actually less than 10%. Over the next few months, I do plan to increase my cash position by reducing some of the asset allocation that I have towards equities. And the reason why equities are roughly 83% if you add shares and blend. It's roughly 83% because my shares have gone up quite a lot in value over the past year. I think it's time for me to increase my cash position because I am at a level where I'm a little bit uncomfortable with how much cash I have left on my asset allocation on my portfolio. So that is where I sit at the moment. The next time I give you guys an update on my cash position, it will probably be higher, I hope so. And it's also a good thing to hold more cash because I do see greater volatility coming up in 2021, which means that there might be opportunities to buy shares on the cheap. All right, so there you have it. This is my private portfolio, and that is how I would structure my portfolio. Now, I've structured this portfolio to meet my investment goals of outperforming the market over the long term, which is why I don't really have much of an ETF position in my private portfolio other than what I have on the public portfolio. And I feel like my risk is quite reasonable. I'm not taking excessive risk or anything because these are stocks that I actively follow and I keep a very close eye on them. As well as that, I am a long-term investor, so some of the stocks that I do hold in my portfolio I've held for many years. If I have $10,000 to invest today, I would invest it as I have in my private portfolio asset allocation. However, I might keep, instead of 10% cash, maybe 15 to 20% cash because at the moment valuations does seem kind of high, and I wouldn't be surprised if there was a correction coming up in the future. So lastly, let's talk about the shop where you can buy these asset classes from, the best platforms for you to get exposure to New Zealand stock, US, ETF, and crypto. So for New Zealand shares, the best provider is Sharesies at the moment. There are other providers out there such as ASB and Direct Broking. However, they are a little bit more expensive than Sharesies. For US stocks, however, Sharesies, Hatch, and Stake are your go-to. I've done a review on them. You can check out the video above. For ETFs, you can also check out Sharesies, Hatch, Stake, InvestNow, and Kernel. InvestNow is a free platform for ETFs only. However, if you're investing already on Sharesies and paying the annual fee on Sharesies, then you might as well just do it all at one place. Kernel also provides ETFs. I've made a video on the top 5 ETFs. You can check that out over here as well. And lastly, for crypto, so if you want to buy Bitcoin, gain exposure to cryptocurrencies, then Easy Crypto is the best way to buy Bitcoin in less than 10 minutes. I've done a video on them here as well. And Independent Reserve is probably the better platform if you have a larger amount of money that you want to buy crypto in. So for example, if you want to buy more than $3,000, then Independent Reserve is probably the best platform for you. And if you do want to buy Pokemon cards, you can check out the link in the video description below to my Pokemon online card shop. That would greatly support me making a living and continue doing what I'm doing on this channel as well. And I do have referral links for some of these platforms in the video description below. For Sharesies, Hatch, Stake, Easy Crypto, and Independent Reserve, be sure to check that out down there. Hopefully this would give you a good framework to how you can structure your portfolio. I hope you enjoyed this video. Be sure to hit like and subscribe if you did enjoy this video. And as always, until next time, take care.